All right, so we have a couple of issues we need to talk about to kind of wrap up chapter 9, and then we're going to do our disposals or discarding of assets, and then we'll be done. The first thing is natural resources. Here we're talking about oil fields, natural gas fields, coal mining, and one thing I like to talk about from here in Columbus is our we have a lot of rock quarries around, and so it's something I'll mention in a second. So natural resources are allocated. The costs are allocated in a manner very similar to depreciation, but we use a different term. We call it depletion instead of depreciation. A minor point, but still, it uses a process similar to units of production. So if you know how to do units of production from video 2, video 3, then you're going to be fine with this. It's exactly the same process. For example, here let's assume we have a rock quarry, the land and all the excavation costs $1 million. We estimate we're going to get 500,000 tons of rock out of the ground, no salvage value. And so using the same formula as units of production, we would calculate the cost to be about $2 per ton. Again, that's just the 1 million divided by 500,000 tons is $2 per ton. Once we know that, if we extract 125,000 tons, what would our journal entry be? Well, 125,000 times 2 leaves me this as a journal entry. Note, this journal entry is the same as the depreciation entry, except the word depreciation has been traded out for depletion. That's it. No difference. And so if you're thinking about, if there's any problems or anything, just think about units of production and when you think about natural resources. Intangible assets, just get into it a little bit. When we say intangible, we basically mean assets without physical substance. So not the microphone I'm using, not the computer I'm recording this on, or the computer or phone you're watching this on. Those are things with substance. Intangible assets, no substance. Some examples. Maybe you can identify this. Well, obviously it's a picture of a bicycle, but really this is out of the patent for a bicycle. So you can see this is, if you Google bicycle patent, you should be able to find this picture because that's where I just got it off the internet. But you can see that's what a patent is. A patent is an idea. It's an intangible asset that kind of captures an idea. Another type of intangible asset is a trademark. So you can see this little TM down here in McDonald's. That means trademark. And so this isn't allowed. This is actually a joke from the movie Coming to America. You aren't allowed to take McDonald's logo and just change it around a little bit and make it yours. That's against the rules. It's against the trademark rules, trademark laws. Another example of an intangible asset is copyright. Obviously, the most popular copyright in the world is probably Mickey Mouse. And so you cannot legally just put Mickey Mouse in your movie. There's rules that limit the use of that because of copyright laws. So we end up with intangible assets, patents, trademarks, copyrights, which I've talked about, franchises. If you pay money for a franchise, that money is really nothing in terms of its tangibleness, but it is an asset called a franchise. Goodwill is another intangible asset. It's a cost. If you overpay for a business, you create an asset called goodwill, which is potentially amortized or impaired. And much like your natural resources, you amortize instead of depreciate. You amortize. Intangible assets, however, will use straight line instead of units of production. They'll use straight line, so divided by the life of the intangible asset. All right, let's get down to it here. Our last topic is the discarding of plant assets. I do think it's helpful when you're doing these discarding problems to look at your T accounts to kind of see and conceptualize where these things are, because this is essentially these two boxes are summaries of these two statements. If my vehicle cost was $10,000, that would drive what's happening in this account. And if my accumulated depreciation is $10,000, that would be explained here. So essentially, I've summarized these two statements with these two visual squares. Now, before we get too far into it, think about what's the book value of this asset. I think if you always consider, whenever there's a disposal problem, what's the book value of the asset as you're disposing it, it's going to help you get your head around what's happening. So this is an example of a discarded plant asset where it's just gone. We took the truck and drove it off a cliff, or we just left it on the side of the road. We put a Craigslist ad up. Somebody took the vehicle away. The vehicle's gone. So the question is, how do we get rid of an asset on our books? Well, we get rid of it by just removing it from our books. And so starting with accumulated depreciation, if we have a $10,000 credit balance in accumulated depreciation, what do we do to get rid of it? Well, we debit $10,000, taking our balance to zero, and that goes in our journal entry, debit accumulated depreciation $10,000. What about the vehicle? Well, credit the vehicle 10,000. That makes that balance 0, and we're done. That's your journal entry for the discarding of a plant asset. You just remove all the stuff from your books related to it, and then you see where you land. In this case, we gave away an asset with no book value, and so it makes sense that it just disappeared. There's no other implications because it was a worthless, quote unquote, asset on our books. All right, slightly different scenario. Here we have a vehicle with a cost of 10,000 and an accumulated depreciation of 9,000. Well, what's my book value in this scenario? It's $1,000. So now, if I'm going to just dispose of this thing, give it away, I'm giving away something that on our books had a value of 1,000. You could say we estimated the residual value of this to be 1,000, and we just got rid of it. And so that incorrect estimate, this discarding of an item with book value is going to have implications, and you're going to see that shortly. But we do the same thing. First, we're going to get rid of our accumulated depreciation, and then we're going to get rid of the vehicle. And so here we are now. Hopefully at this point, you're like, well, I know we're not done. Yeah, you're right, we're not done. We have debits of 9,000 and credits of 10,000, which doesn't work. And so we need a debit, okay? So in this case, we're going to use an account called loss on disposal, loss on sale, whatever you want to call it. It's going to be a loss account. Keep in mind the loss is similar in terms of its natural balance to an expense. So a loss is similar in its natural balance to an expense. It has a natural debit balance, which is going to increase it. And so as a general rule, if you're here, sorry about that. If we're here and we're not sure what's going on, if we debit in this spot, it's a loss. If we credit in this spot, it's a gain. And you'll see that once we're done. And so you can kind of let your debits and credits dictate your answer, or you can fall back on what you know about the scenario, which is, I know I just gave away an asset with a book value of 1,000 for nothing. And so it should make sense to us that it's a loss. All right, here's another scenario. Same asset, $10,000 cost, accumulated depreciation of 9,000, sold in this case for $1,000. What's my book value of this asset? Well, it's the same $1,000 book value. So I have a $1,000 book value asset that I sold for $1,000. Wait a second, that's a pretty good deal, right? It's about what it's worth. My entry, $9,000 accumulated depreciation, debit to cash 1,000, credit vehicle 10,000, and look what happens. We're done. There's no gain or loss because we thought it was worth 1,000, and we sold it for 1,000. That makes some sense to us. Last example. That same asset cost 10,000, accumulated depreciation of 9,000, sold for 3,000. What's the book value? Well, the book value is the same as it's been, $1,000. The last example was $1,000 book value. We sold it for $1,000. Again, consistently, that makes sense. This is a different story though. We take that $1,000 book value asset, and now we sold it for $3,000. We're going to get a different answer here, and hopefully you can see that. Our entry, debit to accumulated depreciation, debit to cash, credit to vehicle. That's what we know. We know about this stuff. The question is, what comes from here? Well, we need a credit here. We have debits of 12,000, a credit of 10,000. So we're going to credit gain on disposal $2,000. That makes sense. Again, if we're in this spot and we credit, it's a gain. If we think about it intuitively, well, I had this asset I thought was only worth 1, but I just sold it for 3. A gain makes sense there. A revenue, hitting an account similar to revenues. Remember, the gain has a natural credit balance, much like revenues have a natural credit balance. Worksheet 5 is a review worksheet of really the whole unit. You have an asset that we're depreciating using both straight line and double declining balance. And then we sell the asset after 2 years. You're going to depreciate it as if it's a 3-year asset, only for 2 years though, and then we're going to sell it. So good luck. Again, reach out to your instructor if you have questions on these, and take a break after you're done. Good luck.